Hello fellow compounders, welcome back. In a previous episode, I showed you how to invest in the S&P 500 and provided a step-by-step guide. I mentioned or gave you 3 S&P 500 ETF options, which were SPY, IVV, and VOO. Today, we are going to add one more ETF to the mix, SPLG. We will compare them to find out which is currently the best S&P 500 ETF for the individual investor. I'll also tell you about an investment strategy that I've been using since I graduated from college.
This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions.
So let's get started. First things first, ETF stands for Exchange Traded Fund. Think of it as a basket of stocks or other assets that you can buy and sell on a stock exchange using a brokerage account. It's an easy way to diversify your investments without having to purchase each asset individually. So, what is an S&P 500 ETF? These are ETFs that mimic the performance of the S&P 500 index. The S&P 500 index is a benchmark of the US stock market. It includes 500 of the largest companies listed on stock exchanges in the United States. Investing in the S&P 500 allows you to buy a slice of these 500 companies in a single stock or in a single fund. These S&P 500 ETFs are very important to passive investors. Warren Buffett recommended that anyone not interested in doing the work to select individual investments should just buy a portfolio consisting of 90% S&P 500 and 10% short-term government bonds. The most popular S&P 500 ETFs are SPY, which is Spider S&P 500 ETF Trust, VOO, which is the Vanguard S&P 500 ETF, IVV, which is iShares Core S&P 500 ETF, and SPLG, this is a new one, which is Spider Portfolio S&P 500 ETF. So let's compare them based on who is the issuer, what's the expense ratio, which is how much does the fund cost to the investor, and the assets under management, which indicates how big or how much money is invested in the fund. Number 1, SPY, Spider's S&P 500 ETF Trust. The issuer is State Street Global Advisors. It has an expense ratio of 0.95%, or it costs $9.50 for every $10,000 invested. It has over $400 billion in assets under management. SPY is the oldest S&P 500 ETF. It was launched in 1993. It's the most widely recognized and most actively traded of all the S&P 500 ETFs. Due to its age and size, SPY has substantial liquidity and is very popular among institutional investors and traders. It is also a favorite for option traders because it has the most number of option contracts of any S&P 500 ETF. Number 2, IVV, iShares Core S&P 500 ETF. The issuer is BlackRock. It has an expense ratio of 0.03%, that means 3 basis points, or it means that it costs $3 for every $10,000 invested. It has around $350 billion in assets under management. IVV has a very low expense ratio, which is less than 1/3 the cost of SPY. BlackRock is a very well-known global investment manager. Number 3, VOO, Vanguard's S&P 500 ETF. The issuer is Vanguard. Jack Bogle was the creator of the S&P 500 Index Mutual Fund, and VOO is a version of that original fund. The expense ratio is 0.03%, the same cost as IVV. It has around $330 billion in assets under management, which is about the same size as IVV and around 20% smaller than SPY. VOO also has a very low expense ratio and it's designed for the long-term investor. Number 4, SPLG, Spider Portfolio S&P 500 ETF. The issuer is State Street Global Advisors. Yes, it's the same as SPY. The expense ratio is 0.02% or $2 for every $10,000 invested. It has around $20 billion in assets under management, which is about 5% of its older sibling, SPY. I think that State Street created this fund to compete with VOO and IVV on price. SPLG reduced its expense ratio from 0.03% to 0.02% on August 1st, 2023. So now it has the lowest expense ratio among the 4. As I said earlier, SPLG and SPY are both managed by State Street Global Advisors. The main differences are the assets under management, expense ratio, liquidity, and trading price. One stock of SPY trades at around $430, while one stock of SPLG is around $50. If you're using a broker that allows fractional share trading, then the price really doesn't matter. However, if your broker doesn't allow fractional share trading, then SPLG's lower stock price gives you more flexibility. It's easier to trade multiples of 50 than trading multiples of $400 per share. Which is the best S&P 500 ETF for individual investors? The best ETF depends on the individual's investment goals, trading habits, and preferences. For long-term buy and hold investors, VOO, IVV, or SPLG might be more appealing due to the lower expense ratios. Over time, even small differences in fees can make a significant impact on investment returns. For active traders, SPY might be preferable because of its unparalleled liquidity, tight bid-ask spreads, and vast options market support. On brand preferences, some investors have a preference or existing relationships with one or the other provider, that is Vanguard, BlackRock, or State Street. This might tilt their preference towards one of the ETFs. And as for accessibility, all of these ETFs are accessible on major brokerage platforms, but even so, some investors might find one easier to access depending on their broker or location. It's also important to note that all these ETFs have performed similarly in terms of tracking the S&P 500. Let's look at a backtest comparing SPY to IVV and SPLG. If I had invested $10,000 in each at the start of January 2006 and kept reinvesting the dividends up to August 2023, this is what we will have. Oh, by the way, I omitted VOO since it has the same cost as IVV and I could only compare 3 positions at a time. So we can clearly see that IVV and SPLG outperform SPY over the long term. This is because their fees are lower. In this case, we would have, at the end of August 2023, $50,777 in SPY, $51,105 in IVV, and $51,106 in SPLG. SPLG and IVV outperform SPY due to its fees. It wasn't much. The annual return difference was 9.67% versus 9.63% annualized. But hey, 4 basis points is 4 basis points. That's a $329 difference over the long run. That is a very good dinner outing. The fee reduction in SPLG didn't occur until August 2023, so it's not reflected in this backtest. I expect that going forward, SPLG should outperform SPY, IVV, and VOO by a couple of basis points. So, since I'm a long-term investor that doesn't use options on S&P 500 ETFs, I'm going to use the ETF with the lowest cost and the lowest stock price. That is SPLG. It has the lowest cost at 0.02%, that is $2 for every $10,000 invested, and it's managed by State Street, the same people that manage SPY. And it has a price in the range of $50 instead of the $400 range of SPY, IVV, or VOO. So it's easier to use if you have a broker that doesn't have fractional share trading, because you could buy multiples of $50 shares instead of having to buy multiples of $400 shares. So from now on, I'm choosing SPLG as my go-to S&P 500 ETF. I do own positions in both VOO and IVV because at the time I bought them, they were the lowest cost providers. If VOO or IVV adjust their prices in the futures to match SPLG, I would reconsider using them again. Now that you have your go-to S&P 500 ETF, let me share a strategy that is perfect for long-term investors like many of you are. Dollar cost averaging, or DCA for short. I've been using this strategy since I graduated from college. What is dollar cost averaging? Simply put, it's an investment strategy where you invest a fixed amount of money into an asset at regular intervals. This can be especially effective with SPLG, which has the lowest expense ratios among the 4 ETFs. Setting up your dollar cost averaging plan with SPLG is easy. This is how I would do it. First, choose a broker that allows fractional trading, like M1 Finance, and open an account. You'll need one to start buying SPLG. By the way, if you need a link to M1 Finance, it's in the comments below. 2, decide your investment amount. This could be weekly, bi-weekly, or monthly. 3. Set up automatic investments. Most brokerages offer this feature, and it's a set it and forget it way of investing. In M1, this is very easy to set up. And that's it. It's very simple. Here's a quick example. Let's say you decided to invest $200 every month into SPLG. In the first month, you would buy $200 worth of SPLG shares. Let's say SPLG is trading at $50. That means that you would have bought 4 shares. That's $200 divided by 50. That's 4 shares. In month 2, you buy another $200 worth, the same amount, of SPLG shares. But this time, SPLG is trading at $40. So you would have bought 5 shares for the same $200. So now you have 9 shares and you had invested $400. Now, in month 3, again, you buy the same fixed amount, $200 worth of SPLG shares. And let's say in that month, SPLG is trading at $45. So you would have bought 4.5 shares. So at the end of those 3 months, you would have 13.5 shares and you had paid $600 in total. So your average cost is $45 during those 3 months. And you continue doing this every single month. All these buys are pre-programmed up front. They are automatic, so you don't really have to do much. The only thing you really have to make sure of is to put money into the account. By implementing the dollar cost averaging strategy, we're spreading the risk and reducing the impact of market volatility. Also, since SPLG has such a low expense ratio, more of your money is going into the investment rather than into fees. So there you have it. If you're a long-term investor, consider giving the dollar cost averaging strategy a try with SPLG. See you in the next video. Always be compounding. Take care.